Morning and welcome to Charting the Markets on Thursday, the 16th of November. Let's begin by having a look at the Nikkei 225 and let's look at Japan. And we can see here that the Japanese stock market has also very much benefited from the lower inflation readings out of the US earlier this week. And you can see here that the Nikkei 225 has risen by over 9%. Since the end of October and is now approaching its high from mid-September, 33,667. And short term, we may well consolidate around that high simply because some investors will probably take short-term profits on their positions. And also ahead of the weekend, some investors might become a little bit more cautious. But the trend's your friend. That is now clearly pointing up again, as we can see here. And above that high from mid-September, we've got the June high, 34,015, to look forward to. And this bullish view from a technical perspective will remain in play as long as we stay above the last reaction high, to say a high, reaction low, I should say, sorry. That is to say a daily candlestick low, which is lower than the one to its left and to its right. That was made on Monday of this week. And in case of the Nikkei 225 at 32,498. So provided we stay above there, further upside looks to be pretty likely over the next few days. And the story is quite similar with regards to the FTSE 100 in that we are short-term consolidating. I mean, yesterday we had some weaker than expected data out of the UK regarding inflation as well. And the UK government must be very pleased with this because basically, even though they didn't have any impact on it directly, they promised that we would halve inflation by the end of this year. And this has now come to fruition. And you can see here the FTSE yesterday rallied to 7,535 on this daily financial bet. But today is trading back below the 55-day simple moving average here in orange at 7,503 and it's just short-term consolidating. But again here, as was the case with the Nikkei 225, provided we stay above the last reaction high, that is to say the high from last Friday, the low, I should say, sorry, at 7,320, provided we stay above there, the odds favor further upside to be seen over the coming days and weeks. And that could then take us up again towards the red line here, the 200-day simple moving average at 7,604, ahead of these highs, which go back to July of this year between 7,702 and 7,047. So short-term consolidation, but within a new uptrend is the theme here. And we can see the same also with regards to the Dow Jones Industrial Average. You can see here that we also rallied very sharply over the last few weeks now that investors seem to believe that the Fed is no longer going to hike its rates and that instead we could see the first rate cut by May of next year. And as investors are pricing in rate cuts in this cycle, the risk-on sentiment has once again risen quite sharply, which is what has driven equity markets up. And also we saw just a few days ago the PPI reading, producer price inflation in the US, also coming in weaker and confirming that a weaker CPI reading from earlier in the week, which is why equity markets rallied even further. We also had some positive retail sales out and basically are now basically flirting more or less with the late August high, 35,099 with regard to the Dow Jones Industrial Average. And we'll have to see whether we can break through that high over the next few days and weeks. And if so, we could then be heading all the way back up again towards the July high at 35,690 and actually finish the year perhaps around the 36,000 mark or so. So things looking quite positive for the Dow Jones Industrial Average. And again here, provided we stay above the last reaction low, that is to say last Thursday's low at 33,854 and above the red line here, the 200-day simple moving average. The trend is your friend and that is pointing up now. And if we also look at the Nasdaq 100, you can see an even sharper advance of some 11% or so since the October lows, which yesterday took us to 15,978, which was intraday higher than the July highs. So a very sharp ascent being seen here, but we haven't managed to close above that July high just yet. So it wouldn't be surprising if short term we were to consolidate slightly, perhaps even come back down again towards the early September lows between 15,628 and 15,520 before we then resume our ascent. Now, if we were to rise above yesterday's high, which I believe to be the case over the next few days, then if we zoom out and go onto a weekly chart, you can see here that we would be trading back at levels last seen in January of 2022. And then the next upside target would be the late December 2021 high at 16,660. So you can clearly see here a very nice bull flag formation in the Nasdaq 100 on the weekly chart, and now the breakout to the upside, confirming that the correction that we've seen over the summer months has now ended and that the uptrend in the bull market has resumed. Over the last few days, the US dollar has managed to slightly regain some of its recent losses as the US inflation data came in much weaker than expected. The US dollar, you may remember, dropped by over a percentage point against a lot of other currency pairs. And over the last few days, we managed to slightly creep back up again. But before I talk about the US dollar against the British pound, for example, I'd like to look at the euro versus the British pound. And what we can see here is that we are now trading at levels last seen back in May of this year, as earlier this morning we headed up to 87.66. And the euro basically is outperforming as the inflation data in the UK came in weaker than expected this week, and basically the Bank of England is now unlikely to hike its rates any longer, and the euro basically benefiting on the back of that. We also have at 11:30 today ECB President Christine Lagarde speaking, so we'll have to see whether that could have an impact on this currency pair. But provided we stay above the last reaction low, that is to say the low from Tuesday of this week, which was made very markedly above the red line here, the 200-day simple moving average at 86.89, provided we stay above there, we are still looking bullish. As you can see here, we have a series of higher highs and higher lows on the daily chart. And that would mean that we could now rise back up again towards levels, as I said, last seen in May of this year, and could perhaps retest the early May high at 88.35. So that would be our next upside target ahead of the April peak at 88.75. So euro sterling looks to have bottomed out, as we can see here, and looks to be heading back up again. Now, the story is not quite similar with regards to the euro against the British pound, the British pound against the US dollar. Yes, we are seeing an uptrend here evolving now since the end of October, but as you can clearly see here, over the last few days, on that weaker UK inflation data, the British pound depreciated against the US dollar and slipped back below the 200-day simple moving average here in red at 124.42. Now, that is not really worrisome to the bulls to any extent at the moment. We're basically just retesting the mid-October high at 123.37, below which we've got another potential support level at the 24th of October high at 122.89. But basically, as long as we stay above the last reaction low, that's to say the low from last Friday, at 121.88, the uptrend should remain intact with regards to the British pound against the US dollar. And last but not least, I'd like to mention the US dollar against the Japanese yen. And again, here over the course of this week, we had a pretty sharp drop in this currency pair as the weaker US CPI and PPI data pushed the US dollar down. But since then, you can see the US dollar is rising again against the Japanese yen, and is heading back up again towards its October 2022 high at 151 yen and 95 cents, which was nearly reached earlier this week on Monday. But I'd like to show you something, and you can see here that we've made a higher high with regards to the price of dollar yen just this week compared to the end of October. But if you look at the relative strength index at the moment, we have a lower high being made here than was the case at the end of October. And that could potentially mean negative divergence. So what it means is that as long as we don't rally above this week's high at 151.91, the odds are pointing towards a possible reversal being seen. So it could perhaps forewarn us that perhaps over the next few days, as we are approaching this October 2022 high in this currency pair, the Bank of Japan might actually intervene with regards to its currency. And that would obviously then lead to a very sharp sell-off again, and we could retest in that scenario the late October, I should say, and early November lows between 149.20 and 148.81. So that is a possible scenario in the days ahead if currency intervention were to be seen. The weaker US dollar benefited some commodities over the last few days, and we'll have a look at some of these. Before we do, I'd like to look at Brent crude oil, because the price of Brent crude oil is coming off again. It managed to rally to $83.79 per barrel on Tuesday, but since then has fallen back down below the 200-day simply moving average at $82.21, and is heading back down again towards the November low that we've seen so far at $79.18. And the reason from a fundamental point of view is that the EIA crude oil inventories data, which was out this week as it was delayed last week, so basically looked back for the last 2 weeks, came in much higher than expected. So we had bigger inventories, larger inventories, and that pushed the oil price down. We also had in China new home prices falling for the 4th straight month, all of which is leading to a lower demand outlook for crude oil. And basically provided we stay above the last reaction high here at $83.79, that is to say Tuesday's high on a daily chart closing basis, this recent downtrend channel should continue into the days ahead and may well take us back down again towards the May high at $78.52. And you can see here we had a very large sideways trading range between the $78.50 mark and also the sort of $71.50 area between May and June of this year, and that's what we're targeting at the moment with regards to the oil price. Now, if we move on to other commodities, Chicago wheat is actually not benefiting from the weaker US dollar, in that we have now slid through this October to November uptrend line and are falling towards the late October and early November lows at around $575, which incidentally was also the low in mid-September of this year. Now, this level is technically important because basically if we were to fall through there and close below it, the odds are pretty high that the wheat price would then head back down again towards the late September low at $552. And this scenario is valid as long as we stay below the $617 high we saw so far this month. So here, technically, we could resume the long-term uptrend after this 1.5 month sideways to upward correction, and basically resume our descent with regards to Chicago wheat prices. And last but not least, I'd like to mention orange juice, because orange juice futures have had a very bullish run this year on the back of crop failures in the main producers of oranges, such as Florida in the US, Mexico and Brazil, and also as a citrus blight has been basically negatively impacting the crop. And here what we're seeing over the last few days is a very sharp acceleration to the upside, taking us to the $400 mark. And above there, we basically have the all-time high, which was made at the end of October at $416 or so. So that's the next upside target. Support comes in at yesterday's price gap here. You can see a minor price gap between yesterday's low at $385.44 and Tuesday's high at $384.05. So that is a minor price gap, which could potentially act as support if we were to see some reversal to the downside. But to me, it looks more likely that once we've broken through the psychological 400 mark, we could be heading all the way back up again to the all-time high at $416 or so. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.